Cool.
Very good.
Good morning, everyone. First of all, just want to say thank you again for having me here to present on this paper. So this paper is basically a climate stress test paper, and this paper is written together with a list of my co-author here. So this is the entire list of my co-author. And so today I'm just going to just like give a little bit introduction about the STRAND project. And so this is a product from the STRAND project first before I go into the paper detail. So this paper is part of a STRAND master project, and so this is a blue sky research from 2021 to 2024. The name of this project is "Should I Stay or Should I Go? Climate Change Risk to Property Value Across Space and Time and the Related Implication of Financial Stability." Just now, Seth mentioned this STRAND project is led by Professor Ivan Dias-Rani. Now he's in Griffith Uni. And it is also led by Professor Anthony Moore. He's from the School of Surveying. So this is a interdisciplinary project that includes like people from science as well as people from economics. So that is Dr. Pontonis, Simon Cox, he is a geologist. Dr. Greg Bodica, he's a climate scholarship. Myself, Owen, and Murray. So for this paper, the STRAND project originally is an interdisciplinary project, and it is funded by the Royal Society of New Zealand. What we look at is the impact of climate change on the real estate market in New Zealand. And it is originally supposed to be a blue sky research, which means that we are just looking at the theory and see like how climate change is going to impact the real estate, the physical market. So that is how it started out. And so along the way, when we start like really working on this project, we start to realize that it have a lot of like, translational implication. And one of the biggest reason is because in New Zealand now is that starting to mandate climate risk disclosure. We have like Reserve Bank of New Zealand who start to do climate stress testing, who also asking like the bank to start consider climate risk in their credit risk rating and stuff like that. And so because of that, we start to see that this project is being translated into kind of like one is on climate stress testing standpoint, another one is on the pricing standpoint. Because like a lot of insurance firm as well as banker, they start to think about, okay, am I going to ask for like homeowner to pay more insurance if their home is stay on a flood hazard zone, or am I asking the homeowner to like start to like pay more mortgage in terms of like if their house are stated in the flood zone? And so that is why we have this project. And so like it belongs to the climate stress testing framework, and it looked at the climate stress test from a bottom-up standpoint. So basically from assess level standpoint. And so back there, so like just now, everyone just heard about TCFD and everything. So actually what happened is that back in 2015, we had TCFD, and most of the climate risk disclosure is actually, initiated by investor. And nowadays in 2020, we see that like the accountant have kind of like taken over the climate disclosure. First, in New Zealand, we claim that we have the first New Zealand climate standard. That is the first TCFD inspired mandated climate risk disclosure in 2023. And also in June 2023, we also have like IFRS, which they introduced the IFRS S1 and S2, also mandate climate change. And so because of that, what we see is that there's a lot of requirement for not only banker, but also insurers, as well as the large listed issuer to disclose not only their current, but also their anticipated impact of climate change on their operation. And not only that, they have to quantify that into dollar value. And so if you look at New Zealand market, we have around 200 entities that is required to disclose, like climate risk. Each of them spend around like 500,000 New Zealand dollar on a disclosure. So this market, just half of that is already $50 million per year. And this is a lot of money. Well, at least for New Zealand, it is a lot of money. In IFRS, they also start to take over climate risk, but then for IFRS, it is very specific. So like they will require each of the sector to disclose the climate risk in in their own way. So with mortgage bank, what they ask for the mortgage bank to disclose is that they have to be able to check like how many mortgage loan that they are having in 100 year flood loan, and how is that going to, how is that going to be translated to like expected loss as well as loss given default, and not only by different kind of like climate hazard, but also by different like geographical region. And so that is what is happening with the IFRS, and in New Zealand context, with this like happening, we also see that there is a climate intelligence arms in the financial market. We have seen a lot of like climate, I would say a lot of climate startup that is like actually opening on transition risk as well as on physical risk. Some just provide a very like basic score. Okay, this is how much your assets score in terms of climate transition risk. This is how much your asset score in terms of like physical risk. And a lot of them is actually very black box. And because that they are black box, sometimes they kind of like lacking scientific validation, and people are relying on that to discuss climate risk. So it is kind of like a very, I would say a very, very time-consuming, expensive activity, but whether it is driving like real action or not, we are not so sure. So with this strand project, we work with the physical scientists. And so Ivan and myself, we are from finance background. We come to, physical scientists. We was like, okay, you should have a flood hazard model that we can use. We're just going to use your data, your model. We are just going to like plug that. We are just going to use very fancy financial calculation. But actually, it turned out that in New Zealand and probably globally, we do not have kind of like a very consistent catastrophic flood model. Well, actually we do, but then it is not that, it is not nuanced enough. So here, when we come to talk to like Simon Fox, he's our hydrologist. When he talk about flood, we just talk about flood generally. But when the physical scientists talk about flood, they talk about multiple things. Like one of the biggest thing is that they talk about the extreme sea, that is the water, the storm surge from the sea, that is one thing. But then there's also flood from the groundwater that is connected to the sea, and that is what they call like groundwater flooding. And then you also have like pluvial flooding from the sky. So we have like all kind of flood, and when they are interact together, it is going to be, a multi-hazard problem. And as in New Zealand, we haven't got a national consistent model for us to do climate stress testing yet. But that is how complicated the physical model look like. So for us, what we did is that, okay, we want to like be able to build like, our framework. We want to be able to do like a climate stress testing from assess level. And so what we did is that we start out with what we have, and we do a bottom-up stress testing. And talking about like climate stress testing, currently there's two different approach. One is a bottom-up approach that use the integrated assessment model, that use like global model that is translated to GDP loss. From GDP loss, the financial institution and the banker, they have to translate that into, like loss given default or probability of default. Then that is a very like common approach that is being used by the central banker. Then another approach is just using bottom-up. For example, you look at Queenstown, you look at all the beautiful houses there, you look at each different house, and you say, okay, what is their current climate hazard? What is their future climate hazard? And how is that going to be reflected in their climate, in the pricing? And so what we did is just very simple. We use the flood hazard model from NIWA. NIWA is one of our cloud research institute. They provide a coastal flood map. And so basically when I talk like they just provide this type of flood, we have some kind of like groundwater floods as well in part of New Zealand, but we don't have the full model for New Zealand. So we are just like looking at this flood only, and that is what we call like extreme sea and coastal inundation. And we just like map that across different increment of sea level rise, going from 0 centimeter to 200 centimeter, so 2 meters of sea level rise. And we want to see like how is that going to be translated to, the future damage of the house in New Zealand, and how is that currently priced, and what is the difference between what is currently pricing versus what should be priced. And that is what we call like overvaluation. And so this paper is actually based on a paper on Nature Climate Change that is published in 2023, that is by Goodrich et al., that look at the US housing market. So talking a little bit about climate stress testing literature, at least for physical risk, we haven't really got a very refined methodology yet. And that is not only in New Zealand, but also globally. I guess like in global context, the market leader in terms of like climate stress testing mostly come from the Bank of Netherlands, Central Bank of Netherlands. They are the first one ever who actually do a climate stress test on the residential mortgage. And also they don't have a physical model for future flood hazard. They don't have that. So what they did is that they do a reverse climate stress testing. But then other than that, a paper by Goodrich et al. Looking at the US housing market, but they are looking at S&P 4.5 only. They do not translate that into financial stability. And there's a paper by in France, they also look at the tropical cyclone and how is that going to impact the bond market. A paper in New Zealand by Pastor Park, they look at like extreme sea level, extreme precipitation and how is that impacting the insurance market. So yeah, what we did is very simple. We just use the extreme sea level map across different sea level increment going from 0 centimeter to 200 centimeter. We also use NZ sea rise projection of sea level rise because New Zealand is very special. It is tilting. So in some part of New Zealand, you will see that like wide sea is rising. The land is rising as well. And so because of that, the relative sea level is actually quite small. In other part of New Zealand, let's say in Wellington, I think that is where like both the sea is rising and the land is like tilting down. And so because of that, they are going to face sea level rise much faster than it should be. What we did is that we use this one and we use ecological property data set. So that includes like 1.9 million houses in New Zealand. And we calculate what is the current price and what is the future price. And from that, we calculate the flow-on effect to bank. And that is what I did. I'm just going to go through like all of this calculation because it's a little bit like, I'll say like, I don't have a lot of time. So I'm just going through like all of the calculation and just go directly to the result. So here is the inundation map in New Zealand. Here is a 1 in 2 year flood event, and here is 1 in 1,000 year flood event. If you look at New Zealand, we have a very long coastal line. 60% of our bank loan portfolio is to mortgage. And I remember 80% of the world is tied to real estate. You look at this and you realize, so actually, New Zealand have kind of like a very, substantial exposure to sea level rise. And most of the area where it's low lying, that should be in the Bay of Plenty and in Hawke's Bay, and in the Auckland area, that is the place where we have the most exposure to like coastal flood risk only. And so this is the model that we rely on. What we did is that we calculate the current pricing, and by current pricing, we measure whether the market is currently pricing present day flood risk, and by present day flood risk, we assume that there is no sea level rise. People are pricing, like coastal flood risk by now, and so we do a very simple hedonic regression model in which we calculate the price of the house as a function of their house structure, of the neighborhood characteristic, location. So for example, if the house is in Queenstown, it is in this like high elevation place, it should have a ragged price and stuff like that. And so we calculate that and we just use a plot, just a dummy indicator and indicate whether the house is located at the present day, like flood hazard zone. And we compare that with the average annual loss of the future damage. And so by future damage, we look at a house and we assume that that house is going to last for 100 years. In that 100 year, the sea level rise will rise incrementally from, let's say, 0 centimeter to 20, hopefully to 20, but maybe to 40 or 50 or 60. It really depends on climate change scenario. And so like on that 100 year, maybe they will have to like expose to one very big extreme flood, 1 in 100 year. Maybe they will expose to like smaller flood which is smaller damage but more frequent. And so that is the concept. That is what we call the average annual loss, a very simple, popular, like catastrophic model term. And so from that, what we did is that we discount that like over 100 years. I can choose like 30 years. That is what people do when they look at the mortgage. But then in New Zealand, we are really lacking house, and we're just looking at like 100 years and see, okay, in the next 100 years, what is the future loss look like? And are people pricing that? And from that, we do a very simple calculation that we translate that into the bank, and we see, okay, whether it is going to elevate the credit risk of homeowner, whether is that going to impact the probability of default, whether it is impacting the the loss given default, and how is that going to affect the bank. So moving into the result, this is the main result. First of all, we are looking at here the whole New Zealand market. On the each of the road in here is the increment sea level rise going from 0 centimeter to 200 centimeter. Each of the column in here is different kind of like level of coastal flood hazard. Mean high water spring is when your house is located in a place that is flood every lunar cycle, I think, every like 15 days. AI 1000 is when your house is located in the zone that is exposed to a very extreme flood event, but very extreme, very high, but it is rarely happen. And normally what people care about is mostly AI 100, 1 in 100 year. And they was like, okay, if my house is located in 100 year, normally that is where people often like discount and try to like basically stay away from that area. And so you see that like, well, as of nowadays, New Zealand actually had quite a small exposure to coastal inundation, because we are just looking at coastal inundation only. And the house that is located in the permanent flood zone is around 0.1%, and the house that is located in a 1 in 1,000 flood zone is like 1.1%, but it can increase substantially. And so let's say if we are looking at just 50 centimeters sea level rise, that is equivalent to RCP 4.5 by 2100. Actually, it does not increase a lot. I mean, the maximum it could increase when sea level rise by 200 centimeters, which may not happen in the next 100 years. The fraction of house that is under the water is going from 3.5% to 6%. So actually, it is not a lot because we are just looking at coastal inundation. Then if you look at the coastal flood exposure, it is very, very regional, vary. So mostly, like I said, it's mostly in Hawke's Bay, in Tasman area, those beautiful low-lying places that have a lot of house with millions of dollar view. Those are the places that is mostly exposed to like coastal inundation. 2 minutes, okay. Okay. So basically, sorry, I'm just going to skip this one. What we did is that we calculate the current pricing, and what we found is very interesting. Going from very simple strategy like identification strategy to a very, very complicated one, we found that nowadays people actually do not price properly present-day flood risk. And even though it is counterintuitive, actually it is quite in line with literature. What people found is that like in coastal inundation zone, normally because it has very beautiful view, it kind of like interact with the other amenity that is unpriced, like like beautiful view, beautiful scene, like good air and stuff like that. So like in the coastal flood zone, actually people do not price, and they only price when it comes to like fluvial and fluvial flood zone. Let's say in the Auckland River flooding, people really care about that a lot. Another thing that is really important here is people do not price in this is what we call like 1 in 100 year. They do not price in 1 in 100 year flood event, but they do price in permanent flooding. So which is expected as well. So one of the things that is really important about New Zealand, like I said, it is tilting. It has vertical land motion. And so if we look at the sea level rise, when it goes from 1 to 200 centimeter. If we do not factor that in, the moment it reaches like 50 centimeter, sea level rise is around 2100. But if we factor that in, then sometimes the damage will happen long into the future and not now. And so because of that, the damage will be really minimal if you take the present day calculation. And yes, so basically, actually what we found is that like to the New Zealand market, to the bank, coastal inundation, even when you factor in climate change, even the extreme climate change that is SSP 5, Amber 5, low confidence, the fraction of loss to loan amount is very small, like maximum 1.2%. And here we are like ranking the banks based on their total assets. The bigger the bank they are, actually, the less exposure they are. And here, Kiwi Bank, our only favorite local bank, they are the one that is most exposed to climate risk. Why? Because they are smaller. They can like cater to the smaller coastal yacht that may have more flood hazard. And so there is some problem of equity in climate risk in here. Climate risk is entangled with financial risk. That is what we find. And so like the conclusion of us is that, okay, nowadays, if we look at this very basic climate stress testing, New Zealand have a very small like exposure to climate hazard. And actually, our result is not satisfactory. And the reason why, because we haven't really looked at top-down impact, we look at only two kind of hazard, that is sea level rise and extreme sea level. But New Zealand market, like especially when it comes to river flooding, is much more exposed than that, and we haven't even like looked at precipitation and anything else, and we haven't even looked at groundwater yet. And so what we plan to do next, we are planning to do now, is that we need to be able to factor all of those in. And we plan to do a top-down and bottom-up stress test in which we factor in not only the impact of house price devaluation, but also the impact of GDP loss, the impact of unemployment, the impact of people disrupted by the climate flood, and how is that going to impact the house price in New Zealand. And we expect that it will be more realistic, and it should be bigger. That is the end result of our paper. Yeah.
So unfortunately, the discussant